This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, this lecture is on the second chapter in the lecture notes. It's on conflicts of interest and the resolution. And again, like the previous chapter, there are no calculations involved here. It's very much a combination of background knowledge and revision of earlier exams. But let me quickly run through what's in the notes. What we're getting at here is, we said in the previous chapter that the director's job, ideally, is to maximise shareholders' wealth. They should be doing whatever's best for the shareholders. However, in real life, they're not always doing that. Directors, there's quite a lot of criticism in many large quoted companies, which is what we're talking about. A criticism that directors are doing things more in a sense for themselves rather than always doing what's best for the shareholders. And to make it clear what I mean, let me just quickly go through that list of specific allegations, specific criticisms that are often made of the directors of large quoted companies. Excessive remuneration. Okay, large quoted companies have special groups of directors, non-executive directors, that determine the remuneration levels, but even so, in many companies, the directors are paid enormous salaries relative to the ordinary workers. There's a lot of criticism. How can you justify paying the managing director X million pounds, X million dollars or whatever? Okay, they say, oh, we need to attract talent and therefore we need to pay a lot of money. But there is this danger that directors effectively are paying themselves more when perhaps they should be paying less, which would mean more for the shareholders. Empire building. Again, I'm not suggesting that this applies to all directors, but it's a criticism that's often levelled. Is that, you know, a director of a large quoted company tends to feel rather important. And a way of becoming even more important is to make the company bigger and bigger by acquiring other companies, creating an empire. And okay, that may be good for the shareholders, obviously, but not necessarily. You know, if they're paying too much to acquire other companies, then that's not good for the shareholders, but it makes the director feel more important. Creative accounting. Again, this has been a very common criticism in some large quoted companies, that the directors, in a sense, cheat. They look for ways of making, when they produce the financial statements, they look for ways of making the company look more valuable than it actually is, or making the profits higher than they actually are. Things like, I've given examples there, capitalising intangibles, things like development expenditure, show it as an asset on the statement of financial position. It makes the company look more valuable. Valuing brands, recognising revenue on long-term contracts early, bringing in more revenue than they perhaps should to make it appear we're more profitable, not depreciating assets the way we should. Now, okay, the Accounting Standards Board comes up with rules about research and development, about depreciation and so on. Not that you need the accounting standards for this exam. But the Accounting Standards Board is there to come up with rules to try and stop this creative accounting. But there are always some companies, some directors, who are trying every way they can to go about making things look better than they are. Off-balance sheet finance. It's common, very common, for companies to borrow money, long-term debt, issue loan notes and things as a way of financing expansion. And there's nothing wrong with that. That's fine. Most companies have long-term borrowings. But if the borrowings start to get too high, the gearing gets high, something we'll talk more about later. There is the fear that it makes the company appear more risky, and shareholders might be unhappy. And so the company usually wants to avoid too much debt appearing in the statements. And so they do things, or they certainly used to do things like, instead of, if they need to buy new assets, instead of borrowing money and buying them, lease them instead. You've still got the asset, but not got the debt, the borrowings showing in the financial statements. Now again, accounting standards deal with that sort of thing, but again, they'd still very often look for ways of trying to get around it. Takeover bids. What we're talking about here is where another company has made an offer to acquire our company, and it could be that this is very much in the interest of the shareholders. That, you know, they're offering an awful lot of money. If it's good for the shareholders, the directors should accept the takeover offer. But directors don't always want to do that. You know, it can, if for no other reason, they could end up losing their jobs. And so there is this danger that directors reject a takeover bid, or do everything they can to persuade shareholders to reject it, because rejecting it's good for the directors, but might not be good for the shareholders. Over the page, unethical activities. Trading with unethical countries, using slave labour, using cheap labour, diverting some of the production overseas to a country where they can get cheap labour, or working under dreadful conditions. Well, fine, it's going to, if they're getting the labour cheap, it's going to make the company more profitable. And if that's all shareholders cared about, fine. But of course, if it's unethical, they shouldn't be doing it. Anyway, those are all examples of the way directors behave, or might behave, I beg your pardon, criticisms of the way some directors behave, when ultimately their job is to maximise shareholders' wealth. The next two bits go together. I mean, agency theory is this relationship between shareholders and directors. That directors are working for the shareholders, they should be working in the best interests of shareholders. None of those criticisms we went through should exist. But the question is, how do we try and make sure they're working in the best interests of shareholders? This conflict of interest, that what's good for the director may not always be best for the shareholders. Standardly, we do it through the way we remunerate them. Look for things like giving the directors profit-related pay, that their salary depends on how much profit the company is making. Higher profit, good for shareholders. If the pay is linked to it, good for the directors as well. Okay, but our problem is, two problems. One is it does encourage them to look for things like creative accounting. If they can make the profits look better, even if they're not, they'll get more pay. And also, it does tend to make them focus more on the short term. You know, if you're a director of a company and your pay this year depends on this year's profits, you'll do anything you can to make this year's profits better, even if it makes things worse next year. You may not be here next year, but there is this tendency to think short term, whereas shareholders really want the directors to focus on the long term. We want steady growth each year, not just higher profit this year if it may make things worse in future years. Another way is to give share options. Give the shareholders shares in the company, and to try and avoid this short-term business, options rather, give them options to buy shares in the company at a fixed price at a future date, or actually give them shares in the company that they're not allowed to sell until the future date. And either way, to be better off themselves, it needs the share price to rise. And of course, if the share price rises, not only is it then good for the directors, it's good for the shareholders as well. So very common is this idea of share options, the right to buy some shares at a fixed price on a future date. And that's what we're talking about in goal congruence. That we should be looking for ways of trying to get the directors to make decisions that, okay, are good for themselves, but automatically at the same time good for the shareholders. Which again, things like profit-related pay, things like share options. Okay, so there we are.